Hi, I'm Joel Shapiro. I teach financial statement analysis for Concordia University in Montreal at the Goodman Institute of Investment Management and the John Molson School of Business there. I also teach accounting to undergraduates at Ryerson University in Toronto, where I live. Today's session has a number of different sections to it, but they all have a common theme, and that is talking about cash flow, particularly operating cash flow. It's a very important number and a very underrated number on the financial statements. In fact, the cash flow statement has only existed for about 40 or 50 years in the format that we see it today, and has undergone a lot of change in that time. The problem for analysts is to understand just what is and isn't operating cash flow as opposed to the other kinds of cash flow, and to understand just what is and isn't recurring or persistent so that proper predictions can be made of a company's future prospects. So let's begin. Classifying cash flow is the first thing you have to do, and as you probably are aware from your study of financial statements, there are three types of cash flow. The cash flow statement itself has three main headings to it, and they are operating, investing, and financing. Operating always comes first, investing is usually second, and financing is usually third. The three together are added together to get the change in cash and cash equivalents for the year. You might think of the cash flow statement as being the difference between two consecutive balance sheets organized in a very particular way to highlight how those differences came about. A bit of history before we start. As I mentioned, the cash flow statement has only been around for about 40 or 50 years, and it has had many names in that period of time. It was originally referred to as the statement of source and use of funds, and funds has variously been defined over the years as cash, cash equivalents, working capital. We've gone back and forth from one definition to the other and then back again over the years, and today cash is defined as cash plus cash equivalents, which is things like marketable securities and so on and so forth. The change in cash and cash equivalents for the year, the difference, the straight difference between the two consecutive balance sheets, is further subdivided by operating, financing, and investing. The three together add up to the total. The operating section can be done in one of two ways on the cash flow statement, the so-called direct method and the indirect method. The direct method simply lists the cash flows: cash collected from customers, cash paid to suppliers, interest paid, taxes paid, and so on. The indirect method starts with net income and reconciles that to operating cash flow by eliminating non-cash items such as depreciation and by unaccruing things like working capital changes, receivables, payables, inventory, and the like. The problem with all that is that non-recurring items, unusual items, aren't easily highlighted in the cash flow statement, and it becomes the job of the analyst to winkle those out to try to get what we call sustainable cash flow. And the rest of this session will be devoted to a number of different topics in that vein. But first, let's see just what is and isn't part of operating cash flow. Operating cash flow includes collections from customers, payments to suppliers. This would be on trade receivables, trade payables, and it doesn't necessarily have to be short-term versus long-term, could be either. Interest and dividends received, interest paid also, and taxes paid. It's interesting, no pun intended, that interest is an operating cash flow, even though the principal payments and principal borrowings will be considered financing or investing, as the case may be. Dividends received, dividend income, that is also considered operating cash flow. Dividends paid, of course, is going to be financing. Now, these things are all part of operating cash flow, as I said, and again, the direct system, the direct method of doing the cash flow statement pretty well looks like this: collections from customers, payment to suppliers, etc., etc. You just list the actual cash flows. Generally accepted accounting principles does not require either the direct or indirect method. It allows both. The direct method is preferred but not mandatory. However, 99.99% of all companies use the indirect method for their statement simply because it's administratively more convenient to put the numbers together in that format. You do have to be familiar with both, though, and be able to convert from one to the other. Now let's see what operating cash flow does not include. Operating cash flow does not include borrowings and repayments. It does not include investments or disposals of those investments. And when I say investments, I'm meaning investments not just in securities and bonds and stocks, but also investments in things like property, plant, equipment, intangibles. Generally speaking, operating cash flow covers everything that you see on the income statement and anything to do with working capital. Long-term assets and long-term liabilities are pretty much excluded from being considered operating. Some characteristics of operating cash flow are as follows. The operating cash flow is considered to be renewable. In other words, it can not only happen every year, but it can happen specifically through the operations and day-to-day activities of the company. It's recurring as opposed to being one-time events, and it's normal. In other words, through normal, typical business operations. So the kinds of things that should be excluded from operating cash flow would be things from non-recurring events, extraordinary items, unusual items, and so on. We want, as analysts, to get to the point where we can isolate those items of operating cash flow which are going to happen each and every year as a result of the company's day-to-day business activities, and not special things that are extraneous to their everyday business. Now, some of the things that need to be done with respect to, or need to be understood with respect to what is sustainable cash flow are as follows. A second ago I talked about sustainable cash flow, but actually a better way to look at it is to think about what is unsustainable. Those kind of things include one-time events. Examples of that might be major liquidations. Even though this might involve working capital liquidations, these kinds of changes in working capital, major inventory drops, major collections in receivables, would not be considered sustainable because they're not things that you can do every year and stay in business. Similarly, on the payable side, stretching credit, extending vendor payment terms, this is something that you can do once in a while, but eventually your vendors are going to object, they're going to catch up to you, and you're not going to be able to do it on a regular basis. So these kinds of things would be sources of operating cash flow. They do affect working capital, but they are not considered to be sustainable cash flow, and that's the big difference that analysts have to be able to understand. Not all operating cash flow is sustainable. Think about the concept of income persistence. Persistence with respect to income refers to that which will remain and continue for years and years and years. Major decreases in receivables or inventory are things that a company in distress might do, not a company that is going to be a going concern for the foreseeable future. Lengthening the time taken to pay creditors is also something that could be a good decision to do in the short term, but it's not something that can be done in the long term. The creditors are eventually going to object, cut off your credit, and again, that company is not going to be a going concern. Even though major decreases in receivables and inventory, major increases in payables do provide cash flow, particularly operating cash flow, because they're working capital items, these are considered not persistent if they're not something that you can do for years and years and years. They provide one-time boosts to operating cash flow. They may be a symptom of companies in distress, and they may even be precursors to financial shenanigans, which is what financial analysts obviously have to be concerned about. Next, let's look at what investors, both equity investors and lenders, want out of the cash flow statement so that we can determine the maximum decision usefulness of that statement. What do equity investors want? Dividends, obviously. So they're going to be interested in how much cash flow is left over after prior claims for payment of dividends. What constitutes prior claims? Preferred shareholders' dividends, capital expenditures, which are necessary for the maintenance and growth of the company, and interest and principal repayments to lend